Welcome to Chapter 16, where we'll focus on how to allocate support department costs effectively. In this chapter, we'll explore three main methods: the direct method, the step-down method, and the reciprocal method. Each of these approaches has its own way of distributing costs from support departments to operating departments. Besides these methods, we'll also look into common challenges related to allocating costs and revenues, such as dealing with common costs that benefit multiple areas. Understanding these concepts is crucial for accurate cost management and financial analysis within an organization. Let's dive in and get a solid grasp of how these allocation techniques work. When we talk about cost allocation, one of the most important benefits is accurate costing. By allocating support costs properly, we get a clearer picture of what each product, service, or division actually consumes in terms of resources. This completeness is critical for making informed business decisions. Next, cost allocation plays a key role in manager accountability. The rules for allocation help clarify which costs each manager is responsible for managing and justifying. This transparency motivates managers to be more mindful of their expenses and to control costs effectively. Another crucial point is how cost allocation impacts pricing decisions. With better cost information, businesses can set prices more strategically, prepare more competitive contract bids, and ultimately improve overall profitability. In summary, the allocation of support department costs, common costs, and revenues isn't just an accounting exercise, it's fundamental for driving accurate costing, promoting accountability, and supporting smart pricing strategies. These are the core reasons why cost allocation matters so much in any organization. Let's talk about the difference between the single rate and dual rate methods for allocating support costs. The single rate method combines all support costs, both fixed and variable, into one single pool. This means we use one allocation rate for each user department. It's straightforward, making it easier to calculate and explain, but it doesn't give us much insight into cost behavior since fixed and variable costs are lumped together. On the other hand, the dual rate method treats fixed and variable costs separately. Each type has its own allocation rate, which more accurately reflects the different cost drivers behind those expenses. This approach provides better insight for planning and performance evaluation. However, it's more detailed and a bit more complex to implement. Understanding these methods helps us decide how to allocate support department costs effectively to the user departments, which is critical for accurate cost management and financial decision-making. Here, we're comparing the impact of budgeted rates versus actual rates in the allocation of support department costs, common costs, and revenues. Budgeted rates tend to encourage stable planning because charges are known in advance, which helps keep costs predictable. This approach typically places less risk on the user since any variance remains with the support unit. On the other hand, actual rates are more reactive and can weaken cost discipline because charges fluctuate based on actual outcomes. This means users bear more risk, as variances are passed through to them. The choice between these two approaches affects how costs are managed and how incentives are aligned within the organization. Understanding this balance is crucial for effective cost control and resource allocation. On this slide, we're looking at the impact of using budgeted usage versus actual usage when allocating support department costs, common costs, and revenues. When we base charges on budgeted usage, the main advantage is that charges remain predictable. This predictability is important because it means managers aren't penalized for short-term inefficiencies that may occur in other departments. In other words, it smooths out fluctuations, helping managers focus on their own performance without worrying about unpredictable cost swings. On the other hand, when charges are based on actual usage, the costs reflect the real consumption more accurately. This approach sharpens accountability since departments are charged based on what they truly use. However, this also makes cost reports more volatile, which can sometimes cause unpredictability in budgeting and performance assessments. Ultimately, the choice between budgeted and actual usage depends on the balance between stability and accountability that the organization wants to achieve. Understanding this impact is key when deciding how to allocate support costs and common expenses across departments. Now, let's discuss the three main methods for allocating support department costs, each with different levels of complexity and accuracy. First, the direct method is the simplest approach. It allocates support costs directly to operating departments without considering any services exchanged between support departments themselves. While straightforward, it ignores the interactions among support departments. Next, the step-down method provides a more refined approach. It allocates costs sequentially, acknowledging some inter-support services but only in one direction. This means some mutual services between support departments are recognized, but the method doesn't fully capture all reciprocal relationships. Finally, the reciprocal method is the most accurate. It fully accounts for the mutual services provided among all support departments by solving a complete set of simultaneous equations. This comprehensive recognition ensures the most precise allocation of support costs. Understanding these differences is crucial for choosing the method that best fits the complexity and accuracy needs of your cost allocation. Here, we're looking at the direct method for allocating support department costs. The process starts by identifying which departments support others and which are the operating departments that actually deliver the products or services. Then, for each support department, we pick an appropriate allocation base, like labor hours, square footage, or the number of service calls, to assign costs fairly. Next, we allocate the support department costs directly to the operating departments only. Importantly, this method ignores any services provided between support departments themselves, even if they assist each other. This is a key limitation because while the direct method is straightforward and easy to apply, it tends to understate the true support costs since it overlooks these internal support relationships. Visually, you can think of support costs flowing outward from each support department directly to the operating departments without any allocation happening between support departments. This simplicity is what makes the direct method attractive, but it does mean we might not be capturing the full picture of how support costs contribute across the organization. Now let's look at an example calculation using the direct method for allocating support department costs. In this case, we have the maintenance support department with a total cost of $120,000. The allocation base we are using is the number of hours, which totals 6,000 hours for maintenance. To allocate costs to production A, we first calculate the rate by dividing the total cost by the total hours, so $120,000 divided by 6,000, which gives us $20 per hour. Production A uses 1,500 hours of maintenance services, so we multiply those hours by the rate, 1,500 times $20, to get the allocated cost of $30,000 for production A. An important point to note here is that with the direct method, support department costs are allocated directly to operating departments only. There is no allocation of costs between support departments themselves. This method simplifies the process by ignoring inter-support department usage, focusing solely on the operating departments. The step-down method is a way to allocate support department costs sequentially. We start by allocating the costs of the first support department, let's call it Department A. Once Department A's costs are allocated, it is closed, meaning no future allocations go back to it. Next, we move on to the second support department, Department B. Department B can receive allocations from Department A, but once we allocate Department B's costs, it is also closed. Then we proceed to the third support department, Department C, which cannot receive costs from Department B or Department A at this stage. The key idea is that after each support department's costs are allocated, they no longer receive any further allocations. Ultimately, all remaining costs flow into the operating departments, which are the final recipients of these allocated support costs. This method ensures a clear, step-by-step allocation process that avoids circular allocations between support departments. In this slide, we're focusing on the key advantage of the step-down method. Unlike the direct method, the step-down method improves cost allocation by acknowledging some of the support services that support departments provide to one another. Because these departments are allocated in a specific sequence, the costs are passed from earlier departments to later ones. This way, the step-down method captures partial reciprocal service, even though it doesn't fully recognize mutual support between departments. This approach leads to a more accurate allocation of support department costs, as well as common costs and revenues. This improvement is crucial for better reflecting the true cost structure within an organization. Here we're focusing on the reciprocal method of allocating support department costs. Unlike simpler methods, this approach recognizes that support departments provide services to each other as well as to operating units. For example, IT might support maintenance, but maintenance also supports IT. Similarly, HR and the data center exchange services. The key idea is full mutual recognition. Rather than ignoring these two-way flows, we use simultaneous equations to capture the interdependencies. So, the total cost of IT includes its direct costs plus a share of maintenance's costs, and vice versa. We solve these equations together to find the true total costs for each support department. Once we have those totals, we allocate the combined costs to the operating departments. This method ensures a more accurate distribution of support costs by acknowledging the complex interplay among support functions. Here, we're diving into the reciprocal method, which is a mathematical approach to allocating support department costs. The key idea is that support departments provide services to each other as well as to operating departments, and this method captures those mutual services accurately. We start with these simultaneous equations, TIT equals DIT plus AHR times ITTHR, and similarly, THR equals DHR plus 8 times HRTIT. These represent the total costs of each support department, combining direct costs and the costs allocated based on services received from the other support department. To solve for these costs, we use matrix algebra or repeated distribution techniques. Both approaches help us recognize and account for the mutual services before we allocate the costs to operating departments. In essence, the total support cost is calculated as the direct cost plus the support received from other departments. This ensures a more precise and fair allocation of expenses, reflecting the true resource consumption within the organization. When deciding which method to use for allocating support department costs, it's important to consider the specific circumstances of your organization. The direct method is best when you need simplicity and speed, especially if support departments operate independently without much interaction. If there's some level of support between departments, but not complete mutual service, the step-down method is a solid choice. It requires that you can rank the support departments clearly, which helps in allocating costs in a logical sequence. Finally, the reciprocal method is the most accurate and suitable when there is significant interdepartmental support. This method captures the full complexity of cost interactions, but it also demands more computation and managerial effort. So, accuracy versus ease of use and the nature of support relationships are the key factors guiding your choice. Here, we're looking at the challenge of allocating common costs. These are expenses like rent, security, or corporate IT, which all support multiple products but can't be directly traced to just one. For example, products A, B, and C all benefit from the same support services. Since there's no unique way to split these costs, we have to use an allocation rule to distribute them fairly. This is different from costs we can assign directly. Understanding how to handle these allocations is crucial because it impacts how we measure product profitability and make informed decisions. The key takeaway is that common costs require thoughtful allocation since they support multiple products without a clear, individual link. The standalone method allocates joint costs by looking at what each user's costs would be if they were operating independently. First, we start by estimating each product, department, or user's standalone cost, as if they were functioning completely separately. Then, we calculate each party's share by dividing their individual cost by the total of all the standalone costs combined. Finally, we use these percentages to assign the common cost proportionally. This method is particularly useful when multiple users benefit from a shared resource and no single user is considered the primary one. It ensures a fair and rational allocation of support department costs, common costs, and revenues among all users involved. In this slide, we're looking at the incremental method of cost allocation, which is a way to distribute common costs among multiple products or services. The key idea here is that one product is designated as the primary cost bearer. We first allocate the common costs to this main product. This ensures that the bulk of the costs is assigned clearly to one area. Next, we measure what costs remain after this initial allocation. These residual costs are what we call the leftover common costs that haven't been allocated yet. Finally, in the third step, we assign these remaining costs to the secondary products or services. To put it simply, one product takes the majority of the shared costs, and the others only receive the incremental cost above that base. For example, imagine a flight that serves both passengers and cargo. Passenger service might be seen as the primary product that carries the main costs. Then, cargo is assigned only the additional costs that come from accommodating extra cargo capacity. This method helps clarify cost responsibilities by establishing a clear sequence, allowing better decision-making when it comes to managing costs across multiple outputs. Now, let's look at the trade-offs between the standalone method and the incremental method when allocating support department costs, common costs, and revenues. The standalone method treats each user as independently important. This approach has the advantage of being fair and simple, especially when fairness is the main goal. Each user or party is seen on their own, without considering how they interact or overlap with others. However, the downside is that it may overlook potential cost savings that come from serving multiple users together, which can be less efficient. On the other hand, the incremental method focuses on the added cost of serving each additional user. This method is particularly useful when one party clearly plays a primary role, as it allows you to account for that priority in cost allocation. But it's important to be careful here because the results can vary significantly depending on the order in which users are considered, which introduces some negotiation and priority effects. Ultimately, this choice comes down to whether you value fairness and simplicity more, or if you need to reflect priorities and incremental costs explicitly, even if it means more complexity and potential negotiation. In this slide, we're diving into the core challenges of revenue allocation. When companies sell bundled products, it creates a significant ambiguity because the total selling price has to be divided among items that might never be sold on their own. This makes it difficult to determine a fair portion of revenue for each item. Additionally, the standalone values of these products are often unclear, which only adds to the confusion. Different revenue allocation methods can assign varying amounts of revenue to each product, which means the reported margins can shift dramatically depending on the approach used. This complexity extends beyond just products to include the allocation of support department costs, common costs, and revenues, all of which must be carefully considered to get an accurate financial picture. Understanding these issues is crucial for making informed decisions in financial reporting and cost management. Here, we're looking at two main methods for allocating revenue from bundled sales, the standalone approach and the incremental approach. First, the standalone approach spreads the total bundle revenue across each product based on its individual selling price. Essentially, each product gets a share proportional to how much it would sell for on its own compared to the others. The key formula here is, allocated revenue equals the total bundle revenue multiplied by the product's standalone selling price divided by the sum of all the standalone prices. This method ensures a fair distribution based strictly on individual product values. On the other hand, the incremental approach works differently. You start by assigning a fixed, known amount of revenue to one product or a group of products that have priority. Whatever revenue is left over from the bundle is then allocated to the remaining products. So the priority product or group gets their specific share first, and the rest divides the residual. This approach is useful when one product clearly takes precedence in the bundle. Both methods are important for properly allocating revenues, especially when dealing with support department costs, common costs, or combined revenues. Understanding these approaches helps ensure transparency and fairness in financial reporting. Now, focusing on the allocation of support department costs, common costs, and revenues, it's crucial to recognize the role of explicit agreements in this process. When reimbursement is tied to actual incurred costs, having clear and detailed contract terms becomes absolutely essential. These terms need to specify precisely what costs are included, how those costs are measured, and importantly, who is responsible for bearing the financial risk. Without these explicit agreements, misunderstandings can arise, leading to disputes or inefficiencies. So, the key takeaway here is that clarity in contracts ensures smooth allocation and reimbursement, helping all parties understand their roles and obligations clearly. This forms the foundation for effective cost management and fair revenue distribution. Now, let's dive into Chapter 16, which focuses on cost reimbursement risks and incentives. When working with cost reimbursement contracts, there are several potential risks we need to be mindful of. These include cost inflation, where expenses might rise unexpectedly, lack of control over spending, which can lead to inefficiencies, and reimbursement disputes that might occur if costs are not well documented or agreed upon. To manage these risks effectively, it's crucial to have explicit agreements in place. One key area is defining the scope clearly, particularly what costs are reimbursable, so there's no ambiguity. Equally important is establishing the basis for cost allocation upfront, meaning we decide how costs will be allocated before the project begins. We also need to set clear rules regarding rates and usage terms early on, to avoid confusion later. Finally, this chapter covers the allocation of support department costs, common costs, and revenues to ensure proper financial management and accountability throughout the contract. When products are sold together as a bundle, managers face the challenge of allocating revenue to each individual component. This allocation is crucial because it directly impacts how the performance of each product is perceived. For example, how the revenue is split can influence product margins, affect the incentive sales teams receive, and ultimately determine which items appear profitable on the books. The pricing strategy you choose plays a key role in this process. Different methods like using standalone selling prices, incremental pricing approaches, or market values can lead to very different price allocations for each component in the bundle. This means the same bundle could look more or less profitable depending on the allocation method used. Overall, revenue allocation touches not just bundling and product pricing, but also how support department costs and common costs are distributed. Getting this allocation right is essential for accurate financial reporting and effective decision-making. When choosing an allocation method, it's important to match the complexity of the approach to the decision at hand. Simpler, direct methods are easier to apply, but reciprocal methods offer more precision when needed. Next, consider the type of rates you'll use. Budgeted rates can help with planning and provide stability, whereas actual rates may shift inefficiencies onto users, which might not always be desirable. For usage measurement, the key is to pick between budgeted or actual usage based on the behavior you want to encourage in managers. If you want to promote cost control, budgeted usage might be better. If accuracy and accountability are priorities, actual usage can be more appropriate. Documentation is crucial. Clearly define your allocation rules upfront to avoid disputes later over reimbursements or performance evaluations. Remember, the way support department costs, common costs, and revenues are allocated doesn't just impact accounting on paper, it actively shapes managerial behavior and decision-making throughout the organization. As we compare these three methods for allocating support department costs, it's important to understand the trade-offs between complexity and accuracy. At one end, the direct method is the simplest and least comprehensive, as it ignores interdependencies among support departments entirely. This results in lower complexity but also lower accuracy and cost recognition. Moving up in complexity, the step-down method partially accounts for these interdependencies, providing a more accurate reflection of costs but requiring more effort to implement. Finally, the reciprocal method is the most accurate because it fully captures support department interdependence. However, this accuracy comes with the highest level of complexity and demands more resources to manage. Understanding these differences helps us decide which method is most appropriate depending on the balance we need between precision in cost allocation and the complexity we're willing to manage. Let's wrap up with the key takeaways from Chapter 16. First, there are 6 critical decisions that influence how costs and revenues are allocated fairly. The method you choose matters a lot. The direct method is the simplest, the step-down method adds some recognition of partial support, and the reciprocal method is the most thorough and complete. Then, rate design plays a big role too. A single rate approach blends all costs together, whereas a dual rate method separates variable and fixed costs, providing clearer signals for decision-making. Next, whether you use budgeted or actual rates affects incentives and cost control, as well as how much managers are responsible for spending variances. The basis for usage also matters. Allocating based on budgeted or actual usage can either reward good planning or penalize unexpected changes in demand. When it comes to common costs, judgment is essential. Standalone cost allocation focuses on independent valuation, while incremental allocation prioritizes recovery and importance. Finally, revenue and reimbursement need explicit agreements to ensure that bundled offerings and cost-based payments remain fair and transparent. These decisions together help create a more equitable and effective system for allocating support department costs, common costs, and revenues.